Hey traders, in today's episode of the Trading Coach Podcast, I'm going to answer the question of should a trader have a primary and secondary portfolio? And if so, how are some ways that they can set that up? Now, if you haven't done so already, make sure you check out our website, www.tier1trading.com. I just got out of a meeting with our partners and we've got some really cool stuff happening that may or may not have happened by the time you hear this podcast, depending on when I put it out. But check it out, www.tier1trading.com. Enjoy all of the content over there, and I hope you guys enjoyed today's episode. Two trading portfolios. What do I think about two trading portfolios? I don't have a problem with multiple trading portfolios. I think that, and there are a few ways you can do it. So let's take a look at it like this. You can do it by strategy, or you can do it by duration. So strategy would mean this, right? So when we develop a trading strategy, what's the first thing we need to do for our trading strategy, right? After we learn how to trade, we go into strategy development. We learn a trading strategy. What's the next step, guys? How do we make sure our trading strategy is, profitable? Right? We test it. During the back testing process, we're also developing a portfolio. So a portfolio is like a group of pairs that we plan on trading with that strategy, right? Not all pairs will work the same with all strategies. So ideally, you want to group the pairs that give you the best performance. That doesn't always mean all of the highest performing pairs, but there could be some pairs that are in there just as, I call them like equity account smoothers. Like they don't really help you a massive amount. They don't have the biggest gains, but they help survive those drawdowns. So you can do that with, let's say you do strategy number one. Let's say you're trading a 4-pair portfolio on strategy number one. Everything is going good. You're running on autopilot. Now you want to add a little diversification to your account. Now you add strategy number two, right? Now when you test strategy number two, that strategy could have a completely different portfolio than strategy number one for many reasons. One reason is that maybe it's a different type of strategy. So different pairs have different personalities. Maybe a grouping of different pairs is just going to be the better performing pairs. Another thing is maybe you don't want to have any conflicting signals. Let's say you're doing a counter trend strategy and a trend continuation strategy that may have conflicting signals. You may not want the same pair in both of those portfolios because there may be an instance where you have a trend continuation and a counter trend signal at the same time. And what do you do? So you can certainly switch it up and have multiple portfolios for different strategies. You can do it for duration as well, right? So when I used to day trade, when I swing traded and day traded, I had two separate portfolios, two separate accounts. I looked at them as two separate businesses. And the reason I did that was for two reasons. One, I actually viewed them as two different entities. They had two different, basically, investment strategies. One was long-term growth. The other was kind of short-term pay bills. But I also didn't want contradicting signals, right? So my swing trading portfolio, the duration of those trades were longer, right? So those trades were held typically for hours to days, right? Maybe weeks. Every once in a while you get a big one that lands for weeks. Day trading, that's going to be minute for hours. And I remember I decided to make two different entities when I ran into a situation where I was trading, I believe it was the Aussie dollar at the time, it had to be the Aussie dollar. I was trading the Aussie dollar as a swing trade. And it was like ran into previous structure resistance, and it was a great swing trading opportunity. And I entered it, right? And the Aussie dollar proceeded to do nothing. I wonder if I can actually find it on here. It proceeded to do nothing for about 2 weeks, right? Now, on the lower time frame, my day trading account, while we were in consolidation on the higher time frame, what do you think was happening on the lower time frames? We talked about it earlier. What does consolidation bring? And I'm lagging big time here. My computer's not liking these live streams. What do you think we were doing on the lower time frame while we were consolidating? I think it was might have been somewhere around here. Anyway, while we were consolidating, we were putting in massive amounts of patterns. And I remember I was running a live trading room, and we were nailing pattern after pattern after pattern. I'm talking about like it was like 2 weeks straight of free money. Free money for everyone but me. Because guess what? I couldn't take any trades because I had my position, right? Same account. It was caught up in the higher time frame move that was just bouncing up and down. So I took a trade. I missed about 200 pips of profit from trades I couldn't take, and then the original trade ended up losing. So I was not in a good mood. Let's just say monitors got thrown. Now, luckily, if you guys haven't heard, I have a massive amount of monitors, so it wasn't a problem. But that was kind of the light bulb moment that said, hey, I got to have two separate portfolios so I don't get caught in a position where my money is held up in one thing and I'm missing, another thing. So yeah, I think it's an excellent idea to have two separate portfolios. I don't know if you have to name them primary or secondary. I don't think you have to rank one over the other. But either by strategy or by duration, I think are excellent ways to do it. So that was a very good question, old user 2. What happened to old user 1? Cool. Good stuff. Stewie says, trade different strategies at different times of the year, review when they're most profitable, and you know when to do which strategy. I found that's the best way and less confusing. That's an okay approach. I don't personally agree with that one. I don't think we should try to time different strategies throughout the year. But obviously, if you've done your back testing and you have a track record and you can do a very good job of predicting what strategies work during what time of the year and what doesn't, then you can do that. In my experience, I think it would be rather difficult to. I think the whole timing thing disrupts consistency. I personally, and I would personally rather stay consistent with what you're trading throughout the year and just let the numbers work themselves out than try to pick and choose when you trade what and when you don't trade what. But again, different. Not saying it doesn't work, right? Different strategies for different people. Different markets act differently as well. So a lot of it depends on what markets you're trading to. One last reminder, just because I'm so pumped from the meeting that we just had, lots of new stuff coming over to the Tier 1 trading platform, the 2.0 version of it. I can't spill the beans on exactly what that is, but trust me, you're going to love it. In the meantime, make sure you check out the available content that is currently on the site, www.tier1trading.com, trial memberships, free workshops, courses, software, all of that fun stuff. Head over and indulge.